You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kaastrup-Larsen, are back with this week's edition of the Systematic Investor Series, where each week we focus on helping you build safer and better performing portfolios by including trend following in the mix, and where we do our best to answer all of your questions. Last week you were out, Moritz. Now you're back. Great to have both you and Jerry here online. Good morning. Good afternoon.
Good morning. It's great to be back. Good afternoon. Hi, guys.
Yeah, absolutely. And what a month May turned out to be. It's certainly been a while since we've seen so many of the kind of classical trend-following markets move this much in a single month. But I don't think you necessarily can say that it was an easy month to navigate. There were quite a few reversals in some of the established trends. Some of the things that I noticed was, of course, grains, which was a difficult sector. The downtrend we've seen for quite a few months suddenly changed course, and we saw a very unforgiving rally, if I can put it like that. And I'm sure that inflicted a bit of pain on the medium to long-term models. Another sector, of course, that were left a bit bruised this month was equities, down 6.5% on the S&P since April 30. Where we also saw a reversal of a strong uptrend in the beginning of the year. But of course, we also saw some trends continue, first and foremost, in the fixed income sector, which really saw a strong rally in May. And I think for some, at least, the late sell-off in energies, I suspect, helped out in the last few days of May. So with all of that in mind, and it being month end, Moritz, how did that all play out for you on your side?
Played out fine. Made 1% in May. That's good. I think I'm still down year to date, about 3%. So that's different to you guys. I think, Niels, you guys are solidly up for the year. That's not the case as far as I'm concerned. But looking back on May, it's been, quite a ride, especially in the last week. Yesterday, crude going down 5-6%, something like that. I had a small short position on in WTI and Brent, so that was great. Heating oil also, so that helped. And the bonds, just continues to amaze me how high they go and how well they trade and trend lately. So I've been making a lot of money from the bonds. Long the dollar, still a good position to have. Have a small position in gold, long silver, short actually, which is interesting. And then the losses, all the equities, Kaastrup, Dow, the S&P, Nikkei, Asika, Eurostoxx 50, all of that cost me money. So, it's been an interesting month. Quite a few changes in positions also. I think I've mentioned on this podcast that I'm long the US dollar against all the other currencies. This is no longer true. I'm now long the Japanese yen against the dollar, which hasn't been the case before. Getting short on some of the equities also, like the mid-cap, the Hang Seng, the Russell. Getting a bit shorter on natural gas. Copper has changed from long to short. So, some movements here.
Definitely some movements, for sure. Interestingly enough, we ended the month exactly where you ended the month. So, small positive, which is always nice. And, still, doing fine year to date. But maybe with a little bit of a difference in terms of how we got there, I would say. Clearly this week, if we just look at the last week, some of the big moves we saw in grains, in, I think, coffee, Mexican peso, really difficult markets to handle from a trend follower or at least from our trend following perspective, but then offset by some nice moves in fixed income and energy in particular. But actually, for us, although grains were down, equities overall were down. It wasn't all negative. There are a few equity markets where we had maintained short positions, in particular in Japan and Australia. So they made us some money. Currencies completely split. Some markets, lost a bit of money, and some markets made money. So I would probably say it was flat overall. Cotton did well, and pretty flat in the metals for the month. Lost a little bit in live cattle, but then obviously the big winners, fixed income and energies. But overall, kind of ended where you were. We've seen some changes, so not necessarily I've noticed any positions being flipped per se, but certainly reduction overall in risk level is one thing I noticed, and also reductions in particular in things like the grains and in stocks overall, not as long as we were coming into the month, and a little bit in fixed income, probably with the volatility picking up. Yeah, I mean, interesting month for sure. I feel that there's going to be some return disbursement or dispersion in the trend following area. I think not necessarily everyone had the same exposures positions, which means that you could get quite different results in a month like this. But we only know that in a few days when people start to report their numbers. But yeah, that's how it all played out on our side. Jerry, of course, equities were somewhat in focus, even though there are other markets that had maybe even bigger moves. But what were the important drivers for you this month?
Yeah, well, it was a solid, materially negative month of a nice commitment to equities. There was no diversification there. I've been reading some articles and stuff on Twitter about how talking about finding better stocks and stock picking. And so I think from a CTA or a Jerry point of view, I'm not really thinking about picking better stocks and can outperform in a bad month or in a good month, but it's more like putting together a group of equities to trend follow that are more diversified than an index, or as diversified as possible. So I do have that, but it didn't help this month. So that was a solidly negative in the equities. I'm mostly long, and tremendous reversal in corn from short to long, and then still short positions in all the other. Well, maybe I got a little less short in wheat, but yeah, solid negative. Don't participate in the interest rates like most people when they're getting close to zero or solidly in negative territory. So I'm looking at that like, I missed a big trend, but oh well, that's done me well over the years, but not this year. So yeah.
And I think that's the other takeaway in general, and that is that we often talk about different models and time frames and so on and so forth, where to put your stop and all of that as being obviously very important when it comes to performance, etc. But of course, we should never forget that just portfolio construction, the markets we choose to trade, has a huge impact as well, which is why it's kind of hard to sometimes compare different trend following systems, because a lot of the drivers come from the markets we trade. And we've seen that with some of the other peers in our space, where they have gone towards maybe the less liquid, the newer markets that certainly in our shop we wouldn't trade because we don't feel they're liquid enough. But of course, where there has been some great opportunities in the last few years, and where they've certainly been helping out on the performance side. So that's just a choice in terms of that. Funnily enough, we have a question or two about markets today when we get to that. So maybe we'll talk some more about that. Before we jump into the Twitter land, so to speak, just want to come back to the thing we've talked about the last couple of weeks, namely the fact that Moritz, Jerry, and I are putting together a live event in New York. We're very excited about it because for us, it's all about trying to break it or to create some real breakthroughs for a small group of people who are into the systematic space. But it doesn't have to be solely based on, what systems, models, et cetera, to do. It could be, questions about business development. It could be about how do you raise your the first $100 million, whatever it might be. We have all been there, done that. And we very much look forward to being in a room for a couple of days with 10 or 12, people to do that. Anyways, October 26th and 27th in New York. But we do ask that you raise your hand and commit to this very soon, as we want to firm everything up on our side so we know what we're doing at that time. Good. That was a little bit of housekeeping. Jerry, there are some good tweets this week. I felt not that I spent so much time on Twitter this week, but I saw a few from you. So I'm excited to hear what caught people's attention this week, and so on and so forth.
Yeah, I mean, I think there were some interesting things, and there's a lot of the usual, but I'll try to pick out a few that are different or a little bit different. Can only be so different. But I really enjoy following Wayne. He's been a guest on the podcast. He's really interesting, smart, and he's funny. And he starts off, I'll read a couple, and then you can comment, but he starts off with mistakes are underrated. As I reflect back on decades in trading, the more I realize that the mistakes I made were my greatest teacher. They bite you when they happen, but if you harness them over time, they can foster exceptional growth. Study your mistakes. My comment was a little different and I agree with that totally. I need to like that. I just liked it. And after a while, I realized my mistake was not doing what I already knew was right. I had enough knowledge, or I had some knowledge. I wasn't gonna be a failure. I started studying my mistake of not following my rules. That was my greatest teacher. Granted, my experiences helped me to make better rules. And then he writes, he comments, and this is a really good one. So you learn from your mistakes, and then you realize that your mistake is really not following your rules because we're rules based. And then he goes in a kind of another direction, which is given our bias to judge decisions by outcome, quote unquote, resulting bias. It's so hard to not revise and change what we believe works well. The mistake of perceiving mistakes. I like that. Albeit after the mistaken mistake, we get to further substantiate what's right. Mistakes work again. So that's right. So not following the rules is the ultimate mistake. And then since we're all outcome, I had a bad month last month, and I've had many bad months, or I've had some good months as well. And using some approaches that I needed to stop using. And but I need to not be result biased.
Yeah.
A lot of good stuff.
I mean, I think this thing about, and I've seen it in many other contexts where some of the most successful people in the world in their field always talk about how you learn most from your mistakes. And even though it's something that we don't really want to think about, I think in that context, because we look at failure as something negative. So why is it a good thing to fail and learn from it and so on and so forth? But of course, what we really should do is we should encourage our children to fail and fail, learn to fail well, so to speak, and fail fast, so that you can learn from it. So I mean, it's a classic thing, but it doesn't make it necessarily easier in our space. And that sort of ties over to the book that Annie Duke wrote recently, or published recently, and this thing about, judging the decision maybe in a different way and not judge on the outcome. She uses this example, and you need to guide me here, Jerry, for sure, because it's about American football. But she talks about this example where a team, I forget which one, was up against the New England Patriots, and they had they were like 7 yards from the touchdown line, and there's only like 20 seconds left, and all they need to do was to get the ball and do a touchdown. But the quarterback threw the ball, in one direction, which probably would have worked 99 out of 100 times, but it just didn't work in this occasion, and so they lost the game, and everybody judged him based on that, on the outcome. But actually, the way she explained it, obviously much more eloquently than I do, if you analyze the decision he took, it was a good decision.
Yeah, it's the famous Super Bowl intercept.
Yeah, exactly. So and so some of the things that I talk a little bit about when I meet people, and maybe especially people who might not be so much into trend following, I do mention that what we try to do on our side is not necessarily try to distinguish between good and bad trades or decisions, so to speak. It's about, is our system making an accurate decision based on the data it has at that time? And so whether it becomes a profit or loss, that's not really what we should judge these models on a case by case basis. Obviously, we want to make money over time, but so I think this research into how we as humans make decisions is super important and really relevant for people in the investment industry.
Process over outcome, and I think we all understand this. This is where the similarities are to say poker, where you're dealt a hand and you can you just play it. You play it the best way you can. You follow the process. You follow the rules. You play the best system that the outcome may still be negative, right? You may lose that hand even though you played it well. But if you can repeat it without going bust, then the odds are in your favor. And that's very much akin to what we're doing with our trading. But it's kind of like, I think, we know this, and I want to get back to the mistakes also in a bit, but we know this. It's very difficult, I find, to convey that same understanding and that message to investors and clients who are, joining you in a fund or in a managed account, and they don't tend to see it that way when they're down. When you're losing 3-4 months in a row, which is absolutely possible, and it has happened to all of us, right? Then that's a very negative outcome to them. You may say, well, I followed the process. This is the best I could do. I want to keep on doing this because if you let me keep on doing this, we'll probably be fine. You have to have the patience and follow through. But it's very difficult for people, your loyal clients, to see it in that same way because it hurts them so much to lose that money. And so I don't mind repeating that over and over again. It's the process over outcome, and showing up at that blackjack table, playing that hand of poker over and over and over again in the same way without going bust. That's where the rubber hits the road, right? Without over leveraging. But if you can do this, then there's that's the way forward.
It's so funny, while we sit here and talk literally live on the Twitter feed, is a tweet from Nassim Taleb coming through here, being liked madly. And it goes, if you want to teach someone a real skill, teach him how to fail. He will never learn it in school.
And this is so true, right? Don't let schooling get in the way of your education. I like what Bezos says about this. If you haven't failed, you haven't tried hard enough. Now that maybe putting it into an extreme corner there. Maybe some things you shouldn't be trying super, super hard just to fail. But it is true. I mean, failure is a great teacher if you know how to teach yourself from it. That's also important, right? But that's why I think we've said repeatedly on this show is I think we all continue with our mistakes. I've retweeted Wayne's tweet last night because I also liked it in the same way Jerry liked it. And I just retweeted 100%, and the mistakes keep on coming. And I don't see an end to that. Maybe the big mistakes, they shouldn't recur with the same frequency, or hopefully not at all. That were there 20 or so years ago when it all began. But regardless, there's always smaller mistakes, or at least things that you maybe believe are a mistake and they don't turn out to be a mistake. But all of that process, all of that revisiting, thinking about the system, thinking about potential mistakes, finding actual mistakes and then rectifying them, all of them is part of that journey. And that is why we said experience is so important in that business, because I believe you need to feel those mistakes and live through them in real life, in real time, see what they do in order to be able to learn from them. There's just no way, I think, that you can start out with no experience in the markets, build a trading system, and expect to just run with that and become a successful trader. I just don't see that.
No, and I think that what we definitely can say about this live event where, later in the year, is that a lot of what people really will get from participating in is they're going to learn from our 30, 40 years, and combine much longer years of making mistakes and learning from them. And so that, you don't have to go and make the same mistakes, really, because not that much have changed in how trend following works, and therefore there's a lot of time that can be saved by not repeating the mistakes that we've made along the way, for sure. Jerry, have you got any more?
Well, just to comment on that sports thing, we could talk the whole podcast, because another thing that happened, that's one of the most famous plays of all time, and so it's a lot of what happens in sports. Another thing that kind of happens is, I don't know an analogy in soccer, but in football, it would be something like, should we kick a field goal or should we try for the touchdown?
Right.
And if it's fourth down and you got to make that decision and it's an inch for a first down, a lot of the coaches will kick the field goal because the criticism. Oh my God, the criticism. And the way things are done, quote unquote, this is not how we do things. And so the amount of creativity and risking, and even though the odds are tremendously in your favor, if it doesn't succeed right now on national TV, you're going to get criticized, lose your job. Allocating to CTAs, the same thing. It makes sense. I like it, but I don't know. The risk is really high. It's not what we do. And so I think looking at the odds, when they're so obvious, even for people who have no interest or no talent in looking at odds, they kind of know fourth and an inch is a pretty good bet. But it's not the bet, it's the criticism. And what's it going to mean for me we're looking at all these trades, and hundreds of trades a year, and we can maybe do something that doesn't make a lot of sense, stay in a market and not get out, follow our system. But we're not on national TV, and it's really an interesting situation. And I never really I think that I wouldn't say that this is another thing. I've never really looked at it as learning from my mistakes, because the only mistake I think is not following the system. So once again, I've made some research mistakes and taking profits prematurely. I learned from that, and which is probably another way of not following the system. But losses, and when you follow the system, I wouldn't say that's a mistake, but certainly getting out of a trade too quickly and not following the system. I definitely remember a lot of those, and missing trades totally, not taking a trade. Feb heating oil in 1984. I was sitting on my hands for some reason, and so these are. I think that's sort of the way I look at it.
Definitely, yeah.
And then recently, over the years, and recently, I've been working on different projects and research and trying to make my trend following better. And I keep telling myself, don't give up, keep going. It's not looking good, this big breakthrough or big improvement. And I think that's another thing too, is it's not really a mistake. It's just like you haven't accomplished what you want to accomplish. Maybe you won't ever make it a better approach, but sometimes you will, and you just need to keep pushing and pushing yourself to ignore the pain of not having this breakthrough until you hopefully will have a breakthrough.
Yeah, and I think it's also about learning to enjoy the climb, so to speak. It's not about necessarily getting to the top, right? We probably never get to the top of wherever we're going, so we need to learn to enjoy the climb or the ride up, or whatever you would say. I think that's super important, because it's probably a never-ending quest to try. And there's nothing. I mean, we talk about it often. We talk about, because people ask, so what's the perfect parameter combination, or where do you put your stop, etc., etc. Where our approach is that it's not about perfection. It's about good enough, but also learning to, enjoy that part of it. So even though we all, I'm sure, continue to try and improve, which is part of the journey, of course.
And I don't really look at it in the same way, in that I kind of do think probably that if you didn't evolve so much and you just sort of did the same thing, I think it would not be so bad. I mean, I don't think. I think you can evolve too much and add too many bells and whistles to your approach, and that's going to, you think you're adding and getting better and evolving, but you're evolving in the wrong direction. And so I think to some degree, maybe it's not going to be true in the future, but I think to a large degree, just brute force trend following and diversification is probably okay. But I mean, why stop there? I mean, even if it was okay, why stop? Why not have fun and try to learn and make it better, and learn from your experiences and other people, and listen and steal from others who talk too much on podcasts or in articles. So I don't understand that attitude of, even if you can keep doing it the same way, why would you? This is another thing that we've talked about, but kind of, I don't know. I don't understand this idea of even concerning yourself that exits are more important. I mean, who cares? I mean, I'll spend the rest of my life trying to make my entries better if I want to. I mean, why not? I got nothing else to do. I know putting is the most important thing on golf. Okay, fine, but I got other things I might want to work on as well, even if they're not quite as important. Who cares? It's a big game, and it's putting all of this together and making one immaterial part of your systematic approach a little bit better is definitely something that's worth doing.
Absolutely. Did you have more? I'm sure you do have more tweets. Otherwise, maybe you have some you noticed, Moritz. So I can there's certainly one I noticed from you, Jerry, though. But
I noticed you have a new pinned tweet. Is that actually new, Jerry, or is that an old one? But
it's an old one I keep bringing. It's an old one I keep bringing back.
I'll just read it out. I like it. It's the first time I saw it. So it's: the ideal hedge fund should be like a good local restaurant, reliable, high quality, a loyal group of customers, and unknown to the rest of the world. I like it.
Yeah, it's
very true.
Not an original, and I have the link in there for whoever said it. But I think that's another thing that maybe the CTAs got away from. This getting everyone on the same, getting their clients to understand and enjoy and to buy in and to become converts to trend following. Life will be so much better. 500 million under management, 200 million, $1 billion maybe, but come on, at some level, being a small business with loyal clients, less stress, less people, doing your thing, the lifestyle, the lifestyle that I started out having in 1983, it's just really, really important. And so it's a good lesson it's okay if you have 200 million or 500 million and you're trend following, your clients love you and you're doing a good job. That's totally fine. And maybe the way things should be. Back in the day, at least in the US, one of the rules of the private placement in the fund approach was you needed to know the client before they invested. So there was all things built into this CTA approach that almost prevented you from getting too large. But I think some of those things have gone by the wayside.
Yeah, I mean, it reminds me of a couple of things. Just to comment on the last bit that you mentioned here about knowing your client. I mean, one thing, and maybe that's a legacy that we have carried over. I'm sure it is. I mean, it's a legacy we've carried over from the way Bill Dunn did things. But every single US-based investor who wants to invest in one of our funds, they have to have a qualification call with our owner or our CEO. So we do want to talk to our clients. We don't just want anonymous people investing. Now, we don't do it in Europe because over here it's much more institutional investors. So those I would have met many times before they even invest. But I think it is important about knowing your clients, and I think also the other thing that you mentioned, Moritz, it's put a little bit in perspective when we this week can read about a well-known short-term CTA based over here where I am, closing down, despite the fact it still had hundreds of $1 million under management. And so I think there is some truth. The problem is that probably the ideal size of a CTA or a hedge fund is, as Jerry says, somewhere between 250 million and $1 billion. Yet the investors that, quote unquote, we all would love to work with, some of them don't even look at managers less than 2 billion in size. So we kind of, and I think that's a bit of an issue because it forces people to, I think, outgrow their capacity, which just means the end investors get a worse return, and the people are looking to make the investments are the ones driving the quest for big AUMs, but it just ends up giving them a worse outcome. So it's not necessarily a positive relationship on that front.
Fully agreed. Nothing more to add there. It is like you guys say. I think a smaller fund is a good thing, or at least it's not a bad thing. It's the quality of the lifestyle. You can trade different things. You can trade different types of strategies, which you cannot trade if you're too large. So all of that sounds very good to me.
I also saw a tweet. It's not one of your pinned tweets, Jerry, but I saw a tweet this week. Actually, I think it's from yesterday that I really liked that you had sent out. And it goes something like this. The brightest people I have met share a superpower that would serve investors well. The ability to make inherently complex things simple and understandable. And yet most humans naturally equate complexity with brilliance.
Well, that suits us,
Yeah.
Perfectly. And I think over the years when I have tried to make a point about that, it doesn't resonate with so many people because I'm sitting across from a PhD who's heading up a department at a major firm to allocate and to create a portfolio of different managers. And we get, it looks really simple. Your performance stinks and you haven't done well recently. So I want to stay away from simple, and I don't get paid for choosing simple. Later on, there's a tweet where Wayne talks about information, and we need to not get more information, but better information, or use our information better in better ways. And my comment was, price trends are the best information out there. Follow them. It sounds good, but it needs to be coupled with good performance. And I think people underestimate how difficult it is to put together a top-notch trend following program, because what you were saying earlier about there's so many other decisions that go into it versus just the entries and the exits. It's portfolio composition and are you going to do all the trades? Are you going to not be recent result oriented?
Sure, and how you build your business, how you create a team that will deliver on your mission. You had some other tweets I really liked. I mean, obviously you can go wherever you want, but there was one about a bubble portfolio I recall from this week, and there's one something about momentum and people having looked at it over 200 years. Like, I don't know. These are just from memory. I was looking through my Twitter feed this morning. Do you know what I'm talking about here, Jerry?
Yeah. There was a good article on bubbles, and one of them goes like this: in calling some valuations bubbles, the community implies that it knows more than it actually does. If the bubble portfolio serves any useful purpose, it is to prove that the mainstream gets it mostly wrong when it comes to picking overvalued assets. And this was someone's attempt to put together a few markets into an index that were pretty well acknowledged to be in bubbles, the FANGs, for instance, and it basically did pretty well. And I think that's there's another tweet somewhere about mean reverting, and how sure you can look at valuations, and we know markets do revert to the mean. You just can't predict it. You just don't know what to do. So follow the trend and suffer the drawdown. But some of these bubbles, they keep going.
Yeah, and another thing I wanted to mention this week, of course, speaking about momentum, is of course that our friends at AQR, they're back with their season 2 of their podcast, The Curious Investor. Always great content, and I think actually their first episode in season 2 is about momentum. So if you want to tune in for 20 minutes or so, it's a good listen, I think.
Well, just to keep going on that, this was one I liked a lot from Collaborative Fund. Every Friday, collaborativefund.com puts out some really good stuff that I retweet what we're reading, quote unquote, for the week. So really good. Usually a lot of good information here that has nothing to do with trend following, but I can twist it into trend following pretty easily. Identifying that something is unsustainable does not provide much information on when that thing will stop. Knowing there will be a reversion to the mean does not mean you know when things will revert. Unsustainable things can sustain for a long time. And that's just trend following in general, and outliers, and playing for large moves and not making the mistake of getting out of a good profit too quickly. That's a complaint, that clients would have. Like, why did you hang on? I've had this. Look at this chart. Look at this chart. I've had a person do this to me. How can you not get out here?
Yeah. I heard I listened actually to a podcast where Morgan Housel, who wrote this article, was on, and he's also a great resource, and worth paying attention to for sure. Do you want to keep going, Jared? Do you want to take some questions? What do you feel like?
Let's just do one more from Wayne, which I kind of liked, with the caveat that such indentured servitude is on the heels of rigorously vetted model. Simon can say that with the knowledge of their efforts before implementation, the robustness of their findings, and their ongoing rigor in testing in context, if it works, rely on it. And I say, and rely on your system when it doesn't work. Embrace your indentured servitude. I like the indentured servitude. That's a way of describing how we're going to follow and be disciplined and follow these systems. It doesn't work unless you follow it. And it's this breakout or that breakout is worthless. It doesn't mean anything. It's not saying that selling that breakout and watching the market go down and have an instant profit. It only works if you do it in conjunction with the other with the exit. And so I like the idea that we're so wedded and we're so committed to our following these systems that it's like indentured servitude. I love that.
Absolutely. Super stuff. So the first question we have today is from James. And it's a question about rule tweaking. So here we go. Suppose a trend follow his rules with discipline like a robot. However, he continues to lose money for an extended period of time. When and how do you decide the rules need to be modified to adapt to the market, given the losses, even if he's not losing money and making good money? There is always room for improvement. Would you tweak your existing trading rules that have proven that have a proven track record, given that it looks complacent to stand still after getting good results? This is Jack, all the way from Singapore. He's actually called James, but he called himself Jack in the signature, so it's not that I got it completely wrong in the beginning. But thank you so much, Jack. So, Moritz, for example, what do you think about tweaking rules, and how do we deal with this issue, which I think a lot of people really struggle with, and that is, how do you know if something stopped working, essentially?
Yeah, there's one more person struggling with this. That's myself.
You should come to this workshop, by the way. It's in October.
I will ask the question to the audience, but there is no objective, clear-cut answer for, I think, anyone to determine whether the system is finally broken or not. At least I haven't found that clear-cut answer. So it's a mix of things. It's for how long has it underperformed, given your sample size? Is this a recent observation? Has it underperformed or not performed for 2 years, but prior to that it has performed for 20 years? Well, maybe then I'm not too concerned about those 2 years, even though those 2 years, because they're happening right here, right now, they may feel like an eternity. Then in terms of the statistics, I mean, how much have the statistics, your trade stats, really changed? Your average losses, have they increased? And if so, by how much? Your win-loss ratio, all of that. I mean, there's so many things that I would like to have a look at and then put it in perspective and in relation to the existing market environment. Have markets been trending or not overall? Is there reason to believe, or should we assume that the system should have made money in the markets that we have had? All of this. So yes, I think that if you experience, your system no longer working as it used to work before, and it's continuing to really underperform its history, and sure, do research, see if you can, find things to improve it. But do it very carefully. I always need to kind of hold myself back and, not jump to action just because something hasn't been working for, a couple of months. Again, here we have the process over outcome, right? The outcome may be negative right now, but maybe the process is still correct. So I can't really be of any more help other than saying that at the end of the day, it is a subjective answer for the trader, for the researcher, to find out and to determine as to when the system and the rules need to be changed or tweaked or stopped, replaced, any of that. And I'm afraid that there is, as far as I'm concerned, no black or white answer to that.
What about you, Jerry?
I agree with all of that. I'm all for tweaking. I think you should be very energized and fruitful during bad periods with your research. I like to look at recent trades that were big profits, or I took a lot of losses in a row, and go back and try to look at ways to maybe not give back so much profit or not to take so many losses. Maybe I need to be longer term or be more creative in ways of sitting with a trade for a year or two and then watching all the profit go away in a week or two. I mean, a year or two, and then the profit goes away in a week or two. So, but still, when you come up with these ideas that are being generated due to recent market action, you have to put it in your back test and make sure it doesn't screw up the previous 30 years. So sometimes my tweaking has been just totally had nothing to do with the markets. I just got some creativity at a random time and I made some improvements. But I really like the idea that Moritz said about relative performance to other managers. Everyone made money. Or like for me, like last month, it's probably going to be a small plus or minus for everyone, except for me. I had a big minus. So, why did that happen? Am I still happy about it? More than likely it happened because I have a big commitment to the grains and a big commitment to stocks and no commitment to bond markets that have a negative yield or close to it. So, but, look, you need to be looking at this stuff and be honest with yourself and use these opportunities to question your assumptions and make sure that you still are happy with them.
Yeah, I like that a lot. I mean, I really do think you have to think about, put things in context. I mean, you can't look at it in isolation, that's for sure, and also just look at how the kind of the risk and return profile. I mean, as long as your system is looks and feels like what a trend following system is should be able to produce, one shouldn't panic too early. But I mean, research is an ongoing process, and as Jerry says, you need to make sure that, because every time we make a change, there's the risk that we screw something up. So there's this constant battle between clients maybe wanting us to innovate, but yet they don't want us to change. So that's another thing we have to be careful of, that we probably are talking about relatively small tweaks and not dramatic changes. Now, some managers we all know have made major changes and have changed from being quote unquote pure trend, and that's obviously a different decision. So I think while you were away, Moritz, Jerry and I, on one of the episodes, we talked a little bit about this thing about whether you should trade something that you're comfortable with, or whether you should trade something that is profitable and then learn to be comfortable with it. So I think there's that element as well that plays into it. But it's a great question that Jack posed, because I think it's a question that will always be there. And of course, as Moritz was saying, I mean, there's one thing you can't escape in this industry and in other industries, of course, as well. And that is the value of actual experience. I really, truly believe that there is a difference when you look at a track record of someone who's been around like Jerry or like Don, 30, 40 years. And because we have had to make decisions while things have been difficult about certain improvements or not. And that is very different from someone who's been around for 10 years and have had all that data in their backpack that they could analyze as a backtest and not make decisions in real time back in the 80s, 90s, and so on and so forth. So, of course, our track records can sometimes look more messy, but one shouldn't confuse that with it being worse than a short track record with a more stable return stream, in my opinion. All right, we've got another question from Werner. I think is all the way from South Africa this time. So we're definitely going around the globe today, which is great. Thank you, Werner, for that. I have a question about this goes back to our initial conversation, actually. I have a question about which markets to trade with a rules-based system. I am firmly in Jerry's camp. Trade everything where liquidity is not a restricting factor. Stocks, bonds, currencies, and commodities, I want to trade them all. But I'm also aware that rules-based investing needs trends, and some markets don't really trend. Or so I've heard. So putting aside liquidity constraints and starting from the first principle of trading every market you can, when/how do you decide not to trade a particular market due to an historic lack of trends in that market? This stems from something I read about the original turtles who were told to trade a market consistently. They couldn't dip in and out. Makes sense, but how do you decide upfront which market you will never trade? Great question, Werner, from South Africa. Thank you so much. Why don't we put it to the turtle himself, Mr. Jerry Parker? What do you say?
Well, I say that you should trade all the markets, regardless of what the trends look like in the past. I put together my portfolio weightings based upon just diversification and creating a portfolio that has a low standard deviation or something like that on a daily basis and without regard to historical performance. I think that all of these markets will eventually probably make money, although a few won't, and some will look like amazing. Yen and crude, I used to say, the yen and the crude may end up being the two best markets ever. But I mean, by definition, there has to be the two best markets, but you won't guess which ones they are. And so I do think that trend following theory is that there is no such thing as being able to predict in the future whether something like wheat and bean oil will all of a sudden become great markets. They're all the same. You need to trade them all, or if you decide due to liquidity reasons, or you probably don't need to trade crude and Brent crude, let's say, for instance, that's fine. Just kick one of them out and stay with the other one and always do those trades. So it's a frustrating answer, but it basically, I think, has to do with your desire to create sort of a robust strategy.
Moritz, what thoughts do you have on this?
I agree with all of that. The way I look at it is, my firm belief is that there are trends in markets, or, that markets are susceptible to trends. And that's why I trade a trend following trading system. Now, regardless of whether there have been, a certain number of trends or longer periods of trending behavior in a market, I still want to trade that market. I want to trade that market if it adds diversification to my portfolio, if it really can be looked at as an independent return driver, right? So I'm trading Scandinavian power, BTPs, those are the Italian bonds, the Mexican peso, Japanese equities, Australian wheat, all of that that's an independent source of return. What I want to do is I want to see if there are trends, or my system detects, or it's designed to detect that there are trends in those markets independent of each other, and then try to follow them. But the reason why I trade in the way that I trade is because I'm a firm believer that markets do trend, and I don't want to exclude any market from that observation. So to the extent that I can, I put them all in if they diversify my portfolio.
How many markets do you actually trade, Moritz?
That's now about 65-ish. Yeah.
Okay. All right.
By the way, maybe I should mention that we've added Bitcoin.
Oh my God.
There you go.
You've gone crypto.
Yeah. And, why not? I like it. It's not for the craziness of the crypto, groups out there. I'm not in that camp, but just because it seems to be really, an emotional market. There's huge trends in there, huge moves in there. Of course, position sizes are small, but here you go. It's just what I said. I believe in the context of my portfolio, this market can add diversification. There are trends, so let's do it.
So you trade on the CME, I imagine, futures?
Yes, that's right. That's that's now turned to become the liquid contract. I mean, there's one with the SIBO, which I think is being decommissioned.
Yeah.
And the one with the CME is equal to 5 Bitcoins in terms of contract size. So it's about $40,000 per lot at the moment.
Yeah. Plus, I saw that they had record volumes recently, so that's great. I mean, obviously, we want more markets. I mean, I don't disagree with anything that both of you have said, but I also want to say to Werner that, I mean, I think there are markets that don't trend well, or at least that you can't really capture as a longer-term trend follower. And one example of that would be the VIX. So yes, you can find markets that you probably shouldn't trade as a trend follower. You need a different approach. It doesn't mean you shouldn't trade it. You just have a different approach. But I mean, in many ways, I agree. You want to find many uncorrelated markets, but I also think realistically, it really depends on how big a portfolio you're running. I mean, up until a decent amount of money, you don't have to go crazy in terms of number of markets to trade. I mean, we fall maybe in the camp of being a little bit old-fashioned. I mean, our number of markets is 55, and it's kind of the classical portfolio of futures markets that you would also have found CTAs doing, 10, 20, 30 years ago. It hasn't really changed. We are slow adopters. Maybe one day we'll be trading Bitcoin. Who knows? But that day, won't happen anytime soon. So even though I agree that there are more markets out there that probably have a lower correlation, we can still find enough trends in more the classical markets. So, but I don't disagree with anything that Jerry and Moritz said. So I think, Werner, to answer your question, it's about also what you feel comfortable in terms of how many markets do you really want. But of course, once you have that number based on your asset base, of course, makes sense to find markets that are uncorrelated and therefore represent all of these sectors that you mentioned and that we all trade for sure. So thanks very much again. Our old friend Sam is back with a question. He says it's a little bit of an abstract question, so we'll see. I'm not entirely sure what it's going to be, so we'll see here. Let's see. For many investors, they decrease risk as they near retirement, and they do so by decreasing equities and increasing fixed income exposures. This primarily achieves the desired outcome, but is still variable. And you also have to choose your new allocation levels. If one is a diversified trend follower, wouldn't you say the only decision they would have to make is their general reduction in volatility while keeping the overall portfolio components unchanged? This is very high level, but I wonder if all of you wouldn't comment on how you discuss with investors and view strategic retirement decisions through the lens of trend following. Most of the discussions have been at a more micro level, while this is very macro topic as it relates to investing. It seems trend following just makes investing throughout one's entire life much simpler and more objective beyond a trading and strategy level. Sam, as always, thank you so much for your question. Moritz, do you want to go first on this one, since you have the furthest time to go before retirement? Unless it's early retirement, of course, Moritz. After you started trading Bitcoin, you might retire next week. Who knows?
Yeah, on Monday.
Yeah.
I'm actually looking to do it on Monday, No, but thanks for the question, Sam. I think that's a great question. I like the thinking there. And actually that's, kind of like the way I see it is I don't want to give up on the diversification just because I'm a day older, a week older, a month older, a year older, 10 years older. And the idea of moving to a bonds only portfolio, I mean, right now it's kind of like return-free risk. I mean, bonds, don't forget, bonds are not entirely risk-free. I mean, you may look at the US Treasury bill and say that's a risk-free asset. Okay, fine. thus far it has been. But, look at other countries. If you're not living in the US, if you're living in, I don't know, Argentina, then that bond isn't all that risk-free, right? So it's also a matter of perspective as to, where you are. But the idea of becoming bonds only and giving away all that diversification benefit that I can get from trading 65 or even more markets over time, that doesn't sound right to me. So I'd rather work with, as Sam was alluding to, with, okay, let's lower the level of vol if you don't want to have that large of a drawdown or that large of an expected drawdown in the future. Things like this, right? I don't know, buy a house, stuff like that. But going bonds only, I don't know. That's not for me.
Well, that's a great question. I think this is a very, very good question, but it is not. It is offensive. It would be offensive to the majority of people. It's pretty well recognized that you build a portfolio with a lot of stocks and a few bonds, I guess, 60-40 or less, and then you maybe throw in some alternatives, 5%, 10%, whatever, and then to walk in the room and say, well, this whole idea that you're going to do 90% stocks when you're 20 and then 10% stocks when you're 90, and this is crazy. We trade all of these different markets. You can put your hand over the name of the market. It could be a currency or a commodity or an equity. We don't care. We think they're all the same. We put together this portfolio based upon low correlation, and we don't think stocks are the core. We don't think anything should be the core. We have shorts on. And so if you take the trend following logic the way Sam has, absolutely. It's a vol of 30 when you're in your 20s, and it goes to 20 when you're in your 40s, and then goes down to a 10 vol in this CTA portfolio for you when you're retiring. That's exactly how you would do it. But it's in a very offensive trend following worldview way of looking at things that most people are like, no, that's crazy. And look how well stocks have done. There you go. We'll have a leg to stand on one of these days. We'll have some converts to we have the perfect portfolio. The only thing you need to decide is the right vol for you. I mean, as far as I know, when I get to be 80, maybe I'll still like a 20 vol. I don't know. It's my personality. But maybe when you're in your 20s, you would like a 10 vol. But that really is the question from our point of view. Here's the optimal portfolio, the optimal strategy, small losses, big winners, shorts, commodities. I mean, this violates what most people believe to be true on every level. Check, check, check. It's all wrong because most investors believe, the core is a lot of equities.
Yeah,
the core is trend following.
That's right. The core is risk control, preserving your capital, and understanding that you cannot predict the future, and that bad performance in wheat means nothing for the future. Cover up the market name. You don't even know the name. It's a number. And great performance, stocks, no prediction for the future. Historical returns in a market are not robust. Really? Yeah, that's right. And we talked about this last week, that we're not out there enough being the ones standing up and saying the historical return of the S&P means nothing for the future. That's, once again, it's very offensive, and you're not going to win a lot of friends that way, but it's the truth.
So another way of looking at it, Sam, is of course, and I think you're right in your thinking that, of course, if you are diversified, as Jerry said, you can just change your risk levels along the way. But another way of looking at it, I was going to try and be objective about the investment space as a whole. I would say probably one thing that I have realized over my career is that portfolio construction very often can be incredibly undervalued in terms of its power. And I really truly like the thinking that Ray Dalio is putting forward, especially now that he's semi-retired, where he's being very open about the secret to his success, and it comes down to finding sort of 15-ish uncorrelated return streams and putting them together in a portfolio where you end up, and I'm just sort of thinking of some quotes I've seen from him, but he basically says if you find 15 uncorrelated return streams, you can essentially, for the same level of risk, increase your return by 500%. And at the same time, instead of just looking at one of these return streams, if you combine them together, you reduce the risk of loss from somewhere between 40% down to 11%. And so, as much as I love trend following and think that should be, a core part of your portfolio, I also think the idea of finding and realizing early on, as you, get out of college, start saving up, et cetera, putting together some kind of all-weather portfolio, where, of course, trend following should be part of it, but something that actually can live through the whole part of your own career without you having to think too much about making changes to it, because it's fundamentally true that when you put these uncorrelated return streams together, you have a very solid and robust portfolio. So I like that idea as well, as on as a different path to dealing with how do you invest over time and as you get closer to retirement.
Well,
you want to say something, Jerry?
Oh yeah. I pretty much disagree with maybe all of that.
Okay, good.
Yeah, that's not the way. I don't think it works. Once again, I think historical returns are not a guide for the future.
Agree.
And so, yeah. Well, I don't think you do, because I don't see how you can put together these 15 different return streams without packaging it with trend following. The commodities don't have positive historical returns.
No, I didn't say you shouldn't package it with trend following. Meaning, yeah, go ahead.
Well, you sort of. Well, okay. Well, anyways, I think this is what trend following does in the commodities and the currencies and the interest rates. It makes them profitable. You can't put them into the, you'll see these articles where gold did this or that. Well, what did silver do? Silver's not included because it probably doesn't have a good historical return. And so if you don't package it and wrap trend following around it, you can't get these things into your portfolio because the historical returns won't help. They maybe lose money and they don't do as well as equities. So equities don't need trend following help, let's say, because their historical returns, at least in the U.S., and we've talked about how country by country is falling off this idea that their historical returns in equities have been positive, but the U.S. still remains. But even then, we see that 4% of equities are responsible for all of the return. Not so with trend following. All the equities, almost all of the equities, become profitable. Not just 4%, but probably 94% are profitable if you use trend following. So I think from our point of view, or my point of view, it's not safe to rely upon the historical returns, even of the in the stock market.
So the way I think about it is slightly different. So I agree, you can take markets and put through a trend following process, and I would wholeheartedly say that is a great way of doing it. But you also need to consider, I think, having a different process in order to create a different return stream. So I'm not saying trend following, that you couldn't do it just using trend following, but what I'm saying is that trend following as a whole produces one return stream, and then you have other things that produces different return streams. So it's more the return streams overall that I think, if you put those together and they are uncorrelated, I think overall you have a solid portfolio. Because although you say, well, you can't really rely on historical returns for making prediction about how you should put together your portfolio, well, we're kind of doing some things like that when we build our models, right? We do testing on historical returns, but we are aware of, at least, that it doesn't mean that that's what the future is going to look like. So I'm fully aware that you can put these things together and it may not play out the way you thought. But you want trend following, you want value, you want long gold, you want long equities, etc., etc. I'm sure you, or at least in my opinion, I think you can find things that are structurally uncorrelated and therefore, but they should be profitable as well. Of course, you should believe that they will be profitable as well, and put that together as well. That's Dalio has done it, so it I think that's a good starting point.
Well, you're not going to be able to silence me by telling me Dalio has done it. I don't know how he's done it. I don't know if I believe what he says in the public. I don't care. But no, I think I just look at it. I think what I mean by historical returns is it's not an analogy to bring in what we do, because it's just that here's the return of the market, buy and hold, over the last 100 or 200 or 20 years. Like, that's not reliable. Sure. And when and so anything that gold, I'm not going to do that. I'll trend follow gold. And so you look at trend, you're sort of describing trend following as this holistic approach. No, that's not what I'm saying. I'm saying I'm going to do exactly what Dalio says. I'm going to bring in the soybeans, trend follow. I'm going to bring in cattle, trend following, silver, gold, trend follow, Swiss franc, yen. And so I'm bringing in way more than 15. Not bringing in trend following. I'm bringing in each one of these different markets, different return streams. Cattle and yen are not going to be correlated probably. And then to make it safe and not to have to rely upon a historical return, which is not robust, it's just a fact of life. This is what this market has yielded, returned on a buy and hold basis. I'm going to wrap trend following around all these different, way more than 15, and end up with something that is just as Dalio has said, not only equities as well, but lots of other different things, longs and shorts, which makes it more valuable and more than 15 again, in a sort of a risk-controlled, capital preservation mode.
And I don't disagree with any of that, Jerry, because I think that is the power of what we do. That's exactly right. But if someone came to me and said, yeah, trend following all these markets, that would be one part of my portfolio. But also, like, for example, a process like value with risk management and and over time, that's also, so I think there are other processes you can add together with trend following to make it even, and because here's the thing, as much as we love trend following, we also recognize that we will have severe drawdowns along the way. So, and we also know that there's something called volatility drag. And so the bigger the drawdowns we have along the way, it actually pulls down our compound returns. If we can find something that can also deliver 10, 15% return, but help us reduce the drawdowns along the way, our net return long-term will be better. So that's what I was trying to explain, that maybe there is something out there you can combine with what we do to make the overall even stronger and perform better. But it takes nothing away from what you said, because I completely agree. What we're doing inside trend following, adding all of this to markets and not relying on any, historical price path as such, I think that's fundamental for sure.
Yeah, well, before we let Niels,
he's the judge on this one. He's exactly
separate us. Yeah, yeah. I would just say that we end up with more diversification in our portfolio, with our homes and our jewelry and our many things that we can't trend follow. And I think it's fine to say, I no longer believe trend following works and it's not that great. But I think that as long as you believe in it, then no, it's only the way to go. And it's only because we can't trend follow the gold watches and the diamond rings that our wives have, or our homes and beach houses. If we could, we would. And so, no, I'm not going to give in on that. Go ahead, Moritz.
So here am I. So what I'd like to say to that is, I think the way we trade with the trend following, that adds an enormous amount of safety to our portfolios, which is why we like it. To Niels's point, I like the idea of adding many diversified return streams to a portfolio. And if they exist, well, let's have them. But so I think this is what you're saying, Niels, right? So, add some value, add some growth, add momentum, add, other things. But the one thing I don't want to do is add the long only buy and hold type of return streams to my portfolio. And here's why. Because, you can look at all those markets, say the bond markets, last 30 years, everybody knows that it's been fantastic. The only thing you need to do is buy and hold the stocks, buy and hold the bonds, right? That's the perfect portfolio for the past 30 years. But there has been a period before that. I mean, look at, Germany's history. If you were just long bonds between 1900 and 1950 during, 2 world wars, well, forget about it. That hasn't worked, right? Only because it has worked in the past 30 years doesn't mean that it's a good idea for the next 30 years. So I do want to be diversified, but I also want to have the safety of my trend following trading system applied to those markets all the time, which is why in my personal portfolio, I do not have a persistent exposure to just value, like long only value. I mean, I think, if I ever were to trade the single stock futures like Jerry does, then some of those value stocks would get on my radar screen just because I start trend following them. At a certain point in time, they'll probably start trending up, I'll buy them. So I'll be exposed to those, but I'll be exposed to those during my system. And with all the safety elements and all the risk controls that I've built into that system. And that's how I ideally want my entire portfolio to operate. And to Jerry's point, yes, of course, I mean, the diamond rings and the little, silver bars that we have at home, well, that's kind of like the long only, they look nice type of things we have that we don't trend follow. But it's, as far as the markets and the securities portfolios go, no, trend follow, always with the system, always with the safety belts.
Yeah, because those historical positive returns are just an artifact, a fact of history. They're nothing. They mean nothing for the future.
Yes.
You don't have anything that you should be relying upon. Now, I will say that putting an investment with Niels, with Dunn, with multiple short-term CTAs, systematic risk control, small losses, diversity, it's great. It's fantastic. Not saying, but we know better. And you don't have to agree. And you can, like I said, I think the best comeback is, I just no longer believe in trend following. Oh, that's fine. I mean, that makes way more sense. But if you know what you know, then I don't see how you could prefer anything long only. Different strategy of trend following, maybe.
Because I think, we can look at all those markets. I mean, you could say there's the equity risk premium, right? But being long equities, long only buy and hold all the time. We know that exists, or well, it has existed in the past. It doesn't mean that it's going to exist in the future, but it has existed in the past. It's part of the data, right? But we also know that if we apply trend following to that, we get less severe drawdowns, right? And better risk-adjusted returns. And it tends to, play out that way, that pretty much for every market we apply that on, we get that improvement. And for the entire portfolio, even more so, because we, benefit from the diversification by being long and short at different points in time, rather than long only. That's where the safety is coming from. I think it's true for bonds, it's true for stocks, it's definitely true for currencies, definitely true for commodities, especially the commodities, right? So it needs to be with a system. And I agree with Jerry, it could be a short-term system. In fact, I love those guys. I'm not a short-term trader. I'm not set up that way, but a short-term CTA, 1 to 3 day holding periods, even intraday. Of course, they don't have massive capacity, but enough capacity for me. that is a great benefit to my portfolio. But I think that's a much more reliable, better, greater benefit than adding a long-only value return stream to my portfolio. So I prefer that.
Well, I mean, we shouldn't drag this discussion on too long, because I don't think anyone can doubt the fact that I'm firmly in the trend following camp. So I'm not suggesting that trend following isn't the strategy if you could only choose one. But on the other hand, I don't think we can ignore the fact that trend following doesn't work all the time, right? And we accept that. But if you're looking to build a portfolio, we as trend followers believe in diversification. So why wouldn't we believe in further diversification of different return streams? That I struggle with a little bit.
But we only believe in it in terms of a systematic approach.
Yeah, you could add other systematic approaches to it. Sure.
Right.
Sure.
Right.
The reason I say that, Niels, is, again, I mean, yes, say, look again at value, right? Or say mean reversion, or any of that. If you add that thing to a portfolio that is diversifying, it's diversifying for the past, say, 20, 25, maybe even 30 years, on that long-only basis. Well, because the way it's phrased, it suggests to me that what we're adding, or what you think that we should be adding to our portfolios, is, those long-only type of return streams, like a value exposure. And so you can come to the conclusion that in the past 30 years, value has worked. I'm not saying that it has not. And if you had added this to a portfolio, it would have improved your risk-adjusted returns. What I'm saying is that this thing may have worked in the past 30 years. There may be long periods that you cannot look back onto when it has not worked. And I definitely don't want to say that it's going to work in the next 30 years on a long-only basis in the way that has worked in the past 30 years. But what I'm willing to do for the next 30 years is trade a system with all the risk controls that gets me out of a trade, that gets me short, that is dynamic. Then I'm more comfortable with that. Much more comfortable than adding a risk factor, a long-only risk factor to my portfolio.
Sure. But I mean, for me, it wasn't really a question of one or the other. I'm just saying, I mean, if you believe in the power of diversification, which I do, then there are other things that could be combined with trend following that actually could, as we know, I mean, it could reduce the overall drawdowns of that portfolio. And we know that if you are able to do so, your compound return over time will be higher. So why wouldn't you consider that? And I'm not saying what it has to be. I have never done the research, and I don't know exactly what Dalio did in solving this problem. But I think there is something to it. And as much as I love and believe in trend following, I don't want to be blind that there are other strategies out there that, I do believe, though, that systematic is important. That you have to have rules. I think that's important. I don't think we as investors do well without rules. But I think the perfect person to pick this up with is Corey Hofstein, who, by the way, will join us in a couple of weeks, which will be fantastic. He has a lot of experience, I think, with this particular issue. So maybe that's a good time to continue our discussion.
And I would just add one more thing, unfortunately. Sorry.
Sure.
And that is that
that's good.
And this is the point I'm trying to make, and I'm embracing all of your points, but this is the point I'm trying a hard time getting across, and that is what you just said has historically been true. That's it right there. Has historically been true. So we're not arguing anything like that. You're just not saying, oh, I see what you're saying. It's not that it hasn't historically been true. You don't think it's going to be true in the future. No, it's not even that. There's no evidence it'll be true in the future. Well, how much evidence is there that trend following is going to work in the future? More. It doesn't look that great right now, but more. It's not enough, maybe, for lots of people, most people. It's a personal decision, but it's a hell of a lot more than it's historically been true, quote unquote.
With those wise words, did we want to talk about, and I don't know if we want to just add your comments. So last week, Moritz, when you were away, there was this study out that actually Michelle from Colonia Capital Management sent me, where they had done some work between noise versus volatility. And Jerry and I was kind of struggling a little bit about how do we really explain noise differently to volatility until Jerry, of course, said, we could just call it, choppiness, which is something I think we all understand. So, but I know you also glimpsed through that study, and thanks again, Michelle, for sending that over. Do you have any views on whether noise is becoming a bigger factor and making it harder for us as trend followers?
Yeah, I like the paper. It's called Deconstructing Noise. It's also the co-author of that is Stefan Martinek, who I happen to know. But, I think what they want to say is, at first, noise is a scientific term. There's a signal to noise ratio. There's, it's used in acoustics, all of that. I think for us traders, choppiness is a better word or a better synonym for noise. I think one of the things that they do, and it's worth mentioning that, is they make a distinction, I think a fair distinction, a good distinction between noise and volatility. And the way they do it is, you may think about, a time series or a process that has one large jump. So there's one massive daily return, and after that it's flatlining. So it's a very volatile movement, very volatile process, but not very noisy because there's just been one big jump and then nothing, right? And you may look at a different time series that's going up and down and up and down and up and down all the time, which is much less volatile than the one with the major jump, but very noisy because there's no clear trend. It's just choppy. But essentially what they're saying is that over the past 10, 20 years, markets have become noisier, choppier, right? There's no, I think, real way to prove what's causing that. They're saying it has probably to do with the fact that participation in those markets has increased. So markets have become more liquid. Have they become more liquid because participation has increased, or has participation increased because they have become more liquid? I don't know, but let's just say there's more people trading the same markets. Everybody's hitting on the S&P 500. The E-mini is pretty much 24 hours in the day. And so, there's more, ups and downs, people trading that all over the world, making the thing noisier, as opposed to some of the emerging markets where there's less liquidity, less people trading that all around the clock, where there are clearer trends. And they come to the conclusion that that the fact that markets have become noisier, that has been to the detriment of trend following performers, because it creates false signals, it delays the entries, it delays the exits. And I think all of that sounds rational. There's also, I want to give a shout out to Perry Kaufman, a good friend of mine, who has many years prior shown the same thing, essentially the same thing, using the efficiency ratio, also showing that, the famous markets, the markets that, we all have in our portfolios, the large CTAs all have in their portfolios, that they have become noisier over time, that their trendiness has essentially decreased over time. And so I found it interesting, and I can only recommend our listeners. It's, it's an easy read, 5, 6, maybe 7 pages. And it's called Deconstructing Noise. You can probably find it on Google, and I think it's also featured in the latest issue of CTA Intelligence.
I think you're right about that. Absolutely. Now, let me just go through the month of May in terms of performance for the various CTA indices, and maybe the two of you will think of some other things to discuss before we wrap up for today. But bear in mind, these numbers are as of Thursday evening, so it doesn't include the last trading day of the month. I'm sure we'll see some small changes. I have a feeling that Friday was a good day for the industry, maybe. We'll see. Anyways, as of Thursday, the BTOP 50 index was down 1.3% for the month, up 3.5% still for the year. SocGen CTA index down 2.1 for the month, up 2.5 for the year. The SocGen Trend Index down 2.31%, up 4.74 for the year. And the SocGen Short-Term Index was down only 21 bips, but still down 2.29 for the year. And finally, the Bridge Alternatives Index down 0.58% for the month and up 3.58% for the year. Any final thoughts, ideas?
I think Friday was a good day. Really negative correlation to the S&P 500 there. That's always good.
Yeah. Well, the indices suggests, not necessarily a negative correlation, but in your case, of course, you're right. Any final thoughts on your side, Jerry?
No. I'm sure it was a negative day for me with the stocks being down a lot.
Yeah. All right. Well, we will wrap up this week's edition that we hope you enjoyed. And we'll be back with much more next week. Before we go, though, as always, we do want to ask if you wouldn't mind sharing this episode with a like-minded friend. It really does help us in the quest for world domination in the podcast space, of course. But in any event, from Jerry, Moritz, and me, thanks so much for listening. We look forward to being back with you on next week's edition of The Systematic Investor. And in the meantime, by the way, do start sending in your questions for Corey, who will be on in a couple of weeks. And we will have another trend-following legend on at the end of the month. Salem Abraham, good friend of ours, will join us for what will no doubt be a very insightful conversation. So send your question through. Make sure you raise your hand and sign up for the live event if you want to have some breakthroughs in this space, October 26, 27 in New York. I think that's it for now. Thanks so much again. Take care.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.